Okay, well, thank you everyone for joining the SPE Young Professionals for this webinar on ESG, past, present, and future. So first off, thank you to our sponsor, Ovintiv, for their continued support of our technical programs. My name is Brendan Ma, and I'm part of the programs team for the SPE Young Professionals. So without further ado, I'd like to introduce our speakers for today, Griffin Smith and Cyprian Georgescu from Energy Minute, which is a grassroots organization seeking to communicate the complexity behind how energy, environment, and technology are intertwined. I find they use a lot of colorful and interactive infographics and occasionally mix in topical humor, making it that much more enjoyable to read. So definitely highly recommend checking them out. Griffin has an undergraduate degree in geophysics, reaching professional status with a PEGA in 2017. He also received his MBA and wrote his thesis on small to mid-sized oil and gas companies navigating the changes of the market in 2018. Currently, Griffin works as a consultant in the oil and gas industry and writes content for Energy Minute. Cyprian also has an undergraduate degree in geophysics and has worked predominantly in the seismic imaging space. His focus is on velocity model building for complex geologic environments. Currently, he writes content for Energy Minute and works on marketing and education for the nonprofit organization. So let's thank Griffin and Cyprian for joining us today.
All righty. Can we see?
Yep.
Perfect. So we'll kick it off here and I'll hand it over to Chip just to get us started.
All right. Hey, everybody. My name is Cyprian and Griffin and I are here from Energy Minute. And today we're going to talk about environmental, social, and governance ratings and touch on their past, present, and future. So as Brendan mentioned, I work in the geophysical space. I've been there for about 7 years now, and mostly we've been working on data sets kind of from around the globe. During this time, I became quite interested in the energy market as a whole, and a couple of years ago, Griffin and I both started participating with Energy Minute. Energy Minute tries to kind of bridge the divide that exists in conversations around climate and energy by producing easy to understand content that is well researched and really digs into some of the nuance and complex realities of our current situation. So we do this through producing a weekly newsletter. We have weekly infographics. We give talks every once in a while, and we also produce content for K-12. So I'm just going to let Griffin introduce himself as well now.
Hello, Griffin. As Chip mentioned, basically similar background to Chip. Have my undergrad in geophysics. Did that for about 5 years, and then I crossed over to the dark side and got my MBA back in 2017. During my MBA, I wrote a thesis how small to mid-sized oil and gas companies navigate the changes of the market. That was back in a probably less exciting time of energy, back in 2018, as Brendan had previously alluded to. Currently, I work in the oil and gas industry as a consultant, and I help build content for Energy Minute. So I wanted to kind of open this talk a little bit with a quote and give a little bit of thought and get our minds kind of thinking in the space a little bit. But this is a quote from Larry Fink, who's the CEO of BlackRock, which is the world's largest investment fund. Basically, his comment saying sustainability and climate integrated portfolios can provide better adjusted returns, risk adjusted returns to investors. That's a pretty interesting quote coming from an individual who manages one of the largest sums of money in the world. So what we'll talk about today, we're going to get into what is ESG and how did it start as the base level. We'll then talk about why it's kind of important and it's come to the forefront now. Then we'll discuss, okay, well then given that, how is it categorized or rated? And then who does that rating? And then based on those ratings, we'll determine, okay, what does that actually mean for markets, industries as a whole from a broader perspective? And then we'll talk about, okay, given that, how are companies reacting to it or navigating that based on those results? From that, we will kind of then jump into, okay, well, let's predict the future. Essentially, what are things trending towards, and what makes sense in that space. And then we'll talk about, well, what does that mean for us, a little bit more locally. And we'll wrap up with, after all of us talking at you guys for all that time, we'll wrap up with a summary and some questions from you guys. Chip, I'll pass it over to you now.
Yeah, so as you may know, ESG stands for Environmental, Social, and Governance Ratings. It's basically a set of standards for how companies operate that are meant to aid a socially conscious investor in screening companies that he or she may choose to invest or not invest in. At its root, it stems from the idea of socially responsible investing. This kind of aims to create either economic, political, social, or in some cases even cultural change by either removing funds or prohibiting their investment in the first place into companies which a certain group finds as immoral. So you can think of activist investors in the 60s and 70s divesting from munitions manufacturers during the Vietnam War, religious groups in the 1910s and 20s divesting from producers of alcohol during prohibitions, or businesses limiting their trade or investment into companies that supported or profited from South African apartheid as examples. Point being that these actions taken by investors are in some way moralistic, and they seek to promote or hinder some form of business because they are viewed as bad for society in some way. Where ESG stands apart is that while ESG also takes a moral stance, the argument, kind of like how Larry Fink said at the very top, is supposed to make financial sense. So the ideas behind environmental, social, and governance standards kind of have been around for quite a long time, but they really, I would say, gained their legitimacy back in 2004, where a landmark paper called "Who Cares Wins" was presented at the World Economic Forum. This was kind of the first time it was represented in front of a globally accepted body, and had the backing of 8 nations to begin with and about 16 financial institutions. The paper kind of supposes that if companies move to abiding by these kinds of ESG standards, that we would have basically more stable markets to invest in, that institutions would have that people would have greater faith in large institutions, and that it would enable sustainable development globally. So this idea kind of took off in the following year in 2005, when the UN backed the principles of responsible investing. So in this paper, kind of further delineated and helped really drill down on what things we should be looking at. As of last year, there was over 1,600 members with $70 trillion under assets managed. There's many nations involved, pretty much all the EU nations, North American, South American, etc. So as time went on, retail investors like you or I started to want to get involved in this as well. And that's why the Standards & Poor's put together the Long-Term Value Creation Global Index back in 2016. This was comprised of companies that basically showed the ability to manage both current and future economic governance opportunities and risks by focusing on long-term strategies. So this gave the general public investors access to investing in these types of products. By last year in 2019, the North American Business Roundtable took place, which was basically made up of the CEOs of the largest companies in the United States, who promoted the idea that America needs to redefine the corporation to promote not only the economic well-being of their shareholders, but that corporations should serve all Americans. So now we're going to dig into why is ESG important. So currently in 2020, it was estimated that there's over 80 trillion in combined assets. They're assigned to basically use ESG ratings in some form. Basically, any company or industry that is seeking to grow needs access to finance and capital to make decisions that they can't fund themselves. So You can think of some of the most popular tech companies in the world, such as Facebook, Apple, Google, and Amazon. They've all vowed to be carbon neutral by 2050, with some of them vying to be carbon negative. Some of the largest oil companies or energy companies on the planet, like Total, BP, Equinor, and closer to home, Enbridge, have also vowed to be carbon neutral by 2050. You've had governments such as the EU passing their Green Deal, which seeks to also promote and incentivize companies into investing into ESG standards. And then kind of most significantly, you've had some of the largest financial institutions on the planet, like the ones you see on the chart in front of you, basically saying that not only will they be carbon neutral in their own businesses by 2050, but that they will seek to finance only companies that abide by ESG standards in some rating. Point being that if you want to do business on a global scale, you will have to deal with these institutions, and they will require you to invest in ESG standards in some form framework. Okay, so as we mentioned, ESG stands for environmental, social, and governance ratings. You can see a little bit of a breakdown for each of them on this slide. This is by no means comprehensive. In fact, MSI, who's one of the leaders in terms of classifying assets, they use a total of 37 criteria under an ESG umbrella. By looking at some of these, you might notice that certain aspects, for example, in dealing with emissions, pollutions, or say water waste, are say easier to place a number rating to than others. Things like human capital, as in how businesses treat their employees, what options they provide for healthcare, for pension funds. That might be trickier to really nail down and agree upon, like what a grade in these areas would be. So ESG ratings kind of would like to be viewed in the same frame of work as a credit rating, which is a really globally agreed upon framework. But much of the issue stands around the fact that not all of these sections are really easy to put a number to. The companies who provide ESG ratings started out as more niche groups in the 80s and 90s who basically would try to sell data to investors that would allow them to make better business decisions and have greater returns based on these ESG ratings. As time went on and ESG as a strategy became more popular, these niche groups were purchased by some of the largest data analytics groups that you see at the bottom there. And so now we're going to take a look at how ESG compares to something like a credit rating.
Yeah, so as Chip mentioned, a lot of those companies have 20 or more years experience doing these ratings. It's pretty significant. So, and given the newer trend and a lot more of the commitments from the capital side, ESG ratings are becoming much more impactful. They are now being used as a metric on how to direct large amounts of money. So given that, the expectation would be that the standardization of these ratings and reporting should be required. Unfortunately, that is not exactly the case right now. So a lot of this information here was pulled from a paper done by MIT, the paper being called Aggregate Confusion. Basically what the paper was attempting to do was pull apart the different ESG ratings and determine, okay, are these different rating agencies correlated in their assessment or are they not? Because if the goal is to get to more of a credit rating kind of level, they should be correlated. So as you can see there on the right, the results showed that basically if you look at credit ratings and you decide on the correlation, basically they're correlated by 0.99, which means that if we're looking at company X and credit rating agency A and credit rating agency B went to give it a score, about 99% of the time they would give it the same score. For ESG ratings, same situation, rater A and rater B would probably give the same score about 54% of the time. That's a large difference. Considering this is something that is directing the flow of a large amount of money, agreement only about 54% of the time with different agencies is pretty impactful. But why is that happening? So MIT's paper dug into this a little bit more in depth. And basically there was a lot of factors that went into this, but a couple things that they pulled out that were like very crucial. Number one, reporting of ESG criteria, as previously mentioned by Chip on the previous slide, it's not required. So those categories that Chip spoke to, those aren't required categories of reporting for a publicly traded company. Whereas for a credit rating agency, that is required. Some of the things that were mentioned on the previous slide, like liquidity ratio, revenue, debt, asset value, that stuff's kind of required from a financials perspective. In terms of standardization, similar situation. In ESG, the ratings are not standardized across the board, whereas credit rating agencies is. And what we mean by standardization, so MIT broke it down into 3 buckets and said, okay, given your rating of company X, how are you measuring that? What are the factors that you're using to measure that? And what are the weights that you're giving to those factors? Those 3 items were not in correlation across rating agencies. They were giving different ratings, essentially. Whereas credit rating agencies, those are pretty standardized. You can't really change basically your ratios. You can't change your revenues to a certain extent. It's pretty standardized. I mean, there's a different accounting systems depending on the country to a certain extent, but pretty standardized, which leads to the result we see on the right there. So based on all of that, or given that as a result, what are companies doing right now? So as kind of touched on by Chip earlier, there's about $80 trillion signed to sustainable investment. In addition to that, Goldman Sachs has committed to $750 billion in sustainable finance over the next decade, and Bank of America has pledged $300 billion towards sustainable investments. That is a large amount of money. And in reaction to that, companies are operating very differently, especially in the energy space. So 2 examples we want to highlight, one being BP, or British Petroleum. They've pivoted a little bit. They've pledged to cut greenhouse gas emissions to net zero by 2050. They've also pledged to spend $5 billion a year on renewables by 2030. What does that mean? Well, basically what that means is they have to divest from their carbon-intensive assets currently so that they can fund these renewable projects. Basically get rid of assets so that they can take that money and reinvest it into renewable projects. So that's the route they've gone. Now, if we look at Chevron has picked up more assets. They acquired Noble Energy for $5 billion for a place in the Permian Basin, and cited synergies and integration to reduce costs, citing that going from end-to-end integration by buying up these assets, they will reduce their costs across the space of it and be more effective going forward. 2 very different strategies, but what are the impacts of those strategies? If we look at it, basically Chevron has picked up more assets, and Chevron is a publicly traded company, so it's beholden to public investors as well as the government. So Chevron now has control of more assets that it is required to continue to improve ESG ratings on, as well as continue to adhere to the goals of governments and investors in the sustainable space. BP, on the other hand, has divested from those assets, so they're no longer in control of those assets. So who picks up those assets and is then responsible for them? Well, it's kind of a question mark, right? We don't really know. But what we have seen are some government-funded oil and gas companies from different nations that pick them up, which means they're not then beholden to public investors or North American governments or whichever it is. Their goals are different. They are goals that are set by whichever nation has funded them, essentially. So potentially, their ESG-focused goals or their environmental impact goals are different. So what's the net change on the environment or social or governance in general across these 2 strategies? Well, Chevron, we kind of know. BP, we don't. It might be a net positive, it might be a net negative, we're unsure. So basically, it's interesting to see that as a result of this conversation coming to the front, there are some secondary impacts that are also we're unsure of right now. So if we start looking to the future, so what does that mean? Basically, 2020 has shown all of us that no one can predict anything, and anything is unpredictable at any given time. But if we look at some of the trends that exist in these different spaces, it tells an interesting story. So if we look at the energy industry, prediction of oil demand or fossil fuel use has been all over the map, generally speaking. But if we look at two sides of the coin, Total has projected a drop in fossil fuel usage, saying that we've reached our peak. It's all downhill from here, saying that demand will decrease by about 50% by 2040. Take it with a bit of a grain of salt because Total has shifted their outlook as well, and they've gone a similar route to BP, and they've divested from some assets and has started investing in renewables. So it's a bit in their favor to shape it that way. On the opposite side, OPEC has predicted the rise in oil demand for another 20 years. So again, they deal in oil and gas assets, so it's in their favor to predict that way. But likely the truth lies somewhere in the middle, but still, we don't really know what tomorrow is going to be like for the demand. What we do know is that China right now is nearly back to pre-COVID fuel demand levels. So they're operating almost back to what they were before things shut down. It's an interesting data point in considering where the energy industry is going. On the investing side, like we talked about, and we mentioned that banks are at this point making their own operations net zero. They're also divesting from or not investing in different companies or industries that are not aiming for net zero. A good example of this too is government doing the same. So in Australia, there's the government there has stopped funding coal projects. So basically they're saying, we will not be putting any more money into this industry. Investors are also betting against ESG ratings. So basically they're saying these ratings maybe don't quite make financial sense. So I'm going to bet against them for my financial gain, essentially. A good example of where this kind of came to fruition was, if anyone's heard of Nikola Motors, they were a company that basically took hydrogen fuel cells to put into vehicles. And this was seen as a very, very positive for the environment, very forward-looking renewables company. So they were getting a lot of investment, and they were getting probably very good ESG ratings. They were getting, their stock prices were going up and up and up and up. But they hadn't even built a factory yet. Tesla had more vehicles in space than they'd even built yet when the stock price of Nikola Motors was higher than Ford. So basically, what happened in the end was the bottom fell out. The realization that the financials weren't there, and then a few other little things to a certain extent that were more of a PR situation, but the financials fell out, the stock price fell down. So it's interesting to consider that while these ESG ratings are impactful, it might not always make financial sense potentially. So for ESG ratings themselves, what's happening? Well, most places are calling for the standardization of these ratings as well as required reporting. So that MIT paper we mentioned, they basically, the conclusion they come to is that it's required for the standardization across the board and required reporting, or else not everybody's playing on the same playing field. You're comparing apples to oranges as opposed to apples. BlackRock is saying the same thing. So that quote we talked about at the very, very top of the very first slide, Larry Fink from the largest investment fund in the world, basically saying these need to be standardized or else it's not going to make sense. You can't financially invest correctly if they're not the same across the board. Other interesting things in the space are that big consulting firms and many firms across the board are looking to become thought leaders in this area, which tells me that they don't see this going away anytime soon. They think that this is very important, and they're going to continue to aim to be leaders in this space. So if we bring that a little bit back to us, what does that mean? Well, really what it means is the initial intentions of ESG are positive, and it's not going to be a thing that goes away. It's potentially just going to change over time. So in terms of what we want to do for maybe a specific investing side, maybe we don't look at ESG as the sole determinant when investing. The example given there of Nikola Motors going through some interesting situations, maybe it's not the best use case quite yet to solely hang our hats on ESG ratings. When we decide to invest in a company, let's also take a look at the source of the ratings and use multiple sources of the ratings. We don't want to use just one data point, right? If there is misalignment among firms because there's no standardization yet, we need to use multiple sources. Additionally, we want to understand the incentive of these rating agencies as well. If there's no standardization right now, well, what's the incentive of these firms? They basically want to entice further investment in their firms so that they can continue to progress. So that being said, they would want to provide essentially recommendations on companies that do well financially, and then maybe they attach the ESG ratings post and attach it how they see fit, because it's more of a gain for them to provide financially sound investments and show that ESG ratings, however they deal it out, make sense. The other point would be to consider the companies within the industry or comparables when you are determining which one to invest in. So the point being here is that since we don't have the ability to kind of standardize across industries and markets yet, maybe look at other companies within the same industry or the same market to compare. So you're not comparing like a Facebook to a manufacturing company because the ESG ratings might not really line up that well. In terms of the career side, there's a lot to think about, but the point here that I want to hit on is that while it's not going away, we also just don't want to jump on a trend immediately. ESG is a good thing. So when you look to invest in a company with your time, they're hiring you and they're investing in you just like you're investing in them. So consider that your values match up with theirs and their actions and their statements. The point here is that if you're going to spend your time working for a company, you need to be clear on what you want to get from them as well in this space. For further information, there's a lot of different sources available for this stuff now. Like we said, MIT is doing some very cool work. They call it their Aggregating Confusion Project. They've really pieced apart this stuff, and it's very interesting to read. Additionally, there's a lot of thought leadership work from reputable firms out there in terms of where they see this stuff going, how they see the space progressing, and what they think needs to change going forward. Additionally, rating agency publications, well, a lot of this stuff is kind of marketing material to a certain extent because they want to draw in investors. It's also interesting to see where their heads are going or what they're putting their efforts into to show. And lastly, investment agencies or institutional investors, their actions and statements tell you a lot. A good example here being the US Labor Board has basically made the decision that they will not be putting pension fund investments into ESG, or will not be factoring in ESG ratings when they invest for pension funds. That tells you a lot, that they don't see the ratings to be at a point yet where they can stand on them for long-term financial gain for their pension funds.
Yeah, so just kind of to summarize a bit, I think environmental, social, and governance ratings are incredibly important. Everybody wants to live in a place that has clean water and a good environment. Everybody wants to work for companies that pay their employees what they're worth. And we all want corporations to act ethically when they make decisions. It's just that the current system as it's laid out is a bit problematic. We aren't trying to, the goal here isn't to muddy the waters, just to kind of point out the fact that the waters are muddy, right? That these ratings agencies don't really agree with one another, and that causes problems for you as a person when you're making a decision, or even for large institutions when they're making decisions. From the career aspect, I think everyone can kind of see the writing on the wall. Western governments especially are pushing more and more for things like carbon pricing and for the incorporations of these kind of standards for pretty much all businesses. So wherever you do end up going to work, these sorts of ratings are going to impact you in some way. So it's important to at least be cognizant and aware of this coming trend. From an investing standpoint, using ESG ratings as guidance for your investments is also kind of unclear. So on the right-hand side here, we have the 26 largest ESG-focused exchange-traded funds in the world. And of those, only a single one has consistently been able to beat the S&P 500 over a 5 to 10 year scale. One of the worrying side effects of the ESG movement is that investors have tended to shift their money into certain firms, which predominantly have been tech stocks, while companies that really need to change, such as energy companies, traditional automakers, mining companies, end up kind of starved of cash and capital and are left in the hands of investors who maybe don't have as much interest in good environmental and social policy. So this approach doesn't really make the world a better place, but rather by starving them of capital, you kind of lock them into damaging practices because they don't have the ability to invest in other areas. When it comes to use of ratings, it's important, like Griffin said, to try to get as many sources as you can under your belt. The paper he referenced, the aggregate confusion paper from MIT, suggested that investors could basically obtain indicator level data from several rating agencies and then impose their own scope and weights to the data. So like as we talked about, how these companies issue their ratings don't always agree with one another. And so it's important for you to be cognizant of that and maybe just use their data to make your own decisions. And then for your own actions, sometimes your values don't necessarily line up with your pocketbook in the short term. But, we believe investing in ESG, while kind of muddy at this point, will become incredibly valuable in the future. There will be no industry left untouched. So whether it's with your time or your money, it's important to be on the lookout for what's coming in this area. So as Griffin mentioned, the MIT's Aggregate Confusion Project is one of the groups that is kind of reaching out to try to standardize these kinds of systems. And they've put together some really interesting and incredible tools when it comes to looking at kind of the broader problem, right? So ESG is really a framework for trying to address climate change in a very serious way. So one of the tools that they put together was this En-ROAD simulation, which I think is on the next slide. And this is just like a fun little chart to play with, which kind of shows the predicted effect of, say, increasing renewables, decreasing oil, increasing energy efficiency, and what that net effect will be on the state of our climate as a whole. And one of the things that MIT is really trying to push and explain with these kinds of tools is that dealing with climate change there is no silver bullet, there is no one technology, there is no one single act that we can do to mitigate these effects, but it will come as a combination of many things. And so ESG in some frame will play an important part of that in funneling capital into the right projects and removing capitals from damaging ones. You can also check out these are just the largest ESG investment companies, sorry, not investment companies, but the data analytics companies that are available right now. A lot of them will post reports that you can look at. A lot of them mention where they got their data from to make their decisions. So like Griffin said, while they do produce a lot of, let's say, marketing content, it's still kind of the closest a lot of us are going to get to really accessing the raw data. Okay.
And lastly, we'd be in trouble if we didn't mention ourselves. So like I said, Energy Minute, we do our best to like kind of make a little bit clear some stuff that is gray. These are a couple of our last 3 focused ESG infographics. Brendan touched on it earlier. We do an infographic every week on a different topic. Most of the time it's energy focused. We also do a weekly newsletter as well. We do our best to kind of approach these things from a bit of a, I guess, interesting perspective. Throw a little bit of unique questioning in there and see what we come up with. But like I said, weekly newsletter, weekly infographics. So figured now we can open it up to further questions. I think I saw there was some questions coming through, so probably address those now, or do our best to anyways in this gray space.
Yeah, thank you, Griffin and Cyprian. That was a really interesting talk about the data underlying ESG. So like you said, we do have quite a few questions coming in. So
Perfect.
I will try to address them in order here that we receive them. So the first one, there's a couple actually that talk to this, is about the path forward of getting ESG ratings more standardized going forward. What do you see for that, let's say in the next 1, 3, 5 years, for example? There's another comment that says every single agency out there wants to become the standard for their own sake, and not for the sake of having the ability to compare investments. So interesting what you guys have to say about that.
Yeah, 100% correct. That other statement is very, very correct. So that was kind of the point I was touching on a little bit there, is what is the incentive of these rating agencies right now? So maybe we take that in consideration before we make decisions, right? But in terms of like best path forward and next steps, I kind of like the way that MIT broke it down a little bit, and basically saying, okay, look, they're not really aligned on what they're measuring. They're not really aligned on how they're measuring, and they're not really aligned on the weight. Their suggestion on kind of path forward is a little bit of regulation around this. If they're looking to become more of a credit rating agency style, you need to have a only set of standards that are acceptable from a regulations perspective and from government. So unfortunately, if you let rating agencies or like the market determine the path forward, it's going to be a little bit all over the map. But if we go the route of looking for regulations and standards from a government perspective, then we hopefully can get all on the same page. And the point being that if we can get everybody on the same page, this becomes a different story, and that capital starts being allocated in the potentially more correct manner in more of an inline fashion, essentially. Hopefully, and more in the space of credit rating agency style, but at the same time with the intention of improving the environment and social and governance aspects as well.
Yeah, and just to add to that, it doesn't, like from the research and reading we've done, it doesn't seem like currently there's a clear winner that will end up as the standard behind it. You know, like the question points out, right? These guys run a business and they want to wholeheartedly defend their position in the market from everybody else. What gives groups like MIT an advantage is MIT's Aggregate Confusion Project has signed up one of the largest pension funds in the United States. And so they are getting backing that's not just from investors themselves, but they have like educational universities, and you know there's whispers of kind of groups from the government coming in to police this kind of stuff as well. So it probably won't necessarily be that you could bet on Refinitiv or MSCI to be like the winner in the long run. It'll probably have to come from some form of like government mandate, because it's just not clear why one ratings agency would have a competitive advantage over another right now.
Great. And just a follow-up question actually on that was, the question was, can you use CSR, so this is corporate social responsibility ratings within industry at this point, or are there still issues with that within an industry? Have oil and gas companies moved towards a standard for CSR? And if so, do you know if companies are leading, or which companies, sorry, are leading CSR?
I'm not sure if you have further insight into this, Chip, but this isn't something I'm extremely well versed in. But again, I would kind of fall back on the statement of, okay, is this an industry standard, or is this a requirement across industries, or is this a government standard? And the point being, going back to the main idea of you can't compare apples to apples, you can't compare apples to apples if you're still comparing apples to oranges, essentially. So while these things will be more fleshed out, and having standards across an industry is beneficial, and it's a good starting point, it's not a full answer to the question. Because we need to now start crossing industries to compare different companies in different industries, different markets, and have a standardized process to do so. I think the other difficulty with that is, to Chip's point when he talked about the factors that are involved here. It's a lot easier to say, hey, your debt to equity ratio is X, versus, hey, your rating on how you treat your employees is Y. So being that that's a very difficult discussion to approach, and I can tell you right now, I'm not the brain to figure that one out. We hope, though, that there's a set of smarter people here that can apply this to an industry agnostic level, and provide that as essentially a regulation or standard to adhere to in the future.
Yeah. So, corporate social responsibility in a way is industry's attempt to kind of self-regulate and police themselves. And I think that there's a lot of worthwhile projects that are being executed through CSR. And while I can't speak to who the leaders might be, I think, it's admirable and it's good that they're contributing in this way. I think the main problem you run into is that you can kind of, invest money into certain projects while externalizing some of the problems companies have, and like not really deal with them in that sense. The issue is that you kind of need an authority to establish a set of rules under which everybody works under. The problem with ESG ratings and even CSR now is that there's no really one set of defined rules, so you can't really, like Griffin said, compare apple to apples to say this group is doing extremely well and should be well funded and rewarded, and this group is not doing so well, because what are you comparing? You don't have like an actual standard by which to say one way or another.
No, fair enough. No, thank you for that answer. It sounds like they're very similar in nature then, on those aspects. A more simple question actually came through, just kind of backward looking, or kind of history matching, like we engineers like to do. Which rating agency has been most accurate? Do you guys know when looking back at the data?
I mean, again, the hard part is, like, it depends what you mean by accurate, right? So like in terms of, let's say, companies that rated highly on ESG scores and then performed financially better, that might be like one way to look at it. I think MSCI has done quite well. They're very popular in that sense, but a lot of this stuff kind of, you look at decisions companies made backwards and then try to guide financial decisions going forwards. All that is to say that, like, they look towards companies that already had a high ESG rating, specifically tech companies, and those companies performed financially very well over time. Whether that ended up being like a benefit to society or the environment as a whole is not really clear. So I don't know if you can pick out a winner who performed the best, because what your definition of best is will change depending on who you ask.
Great. Okay. Next question, pivoting a little bit, is about ESG ratings for technology companies, such as Apple, Tesla, Microsoft. These technologies and the companies and the things that they build, it depends on things like semiconductors, metal mining, as well as other environmental factors. Do you guys know how they get rated on such parameters? For example, who's responsible for the mining emissions? Is it the company? that's doing the mining itself, or is it the end consumers like the Tesla or the Microsoft?
Yeah, so certain ESG rating companies definitely look at supply chains to see where it's coming from. But, you know, kind of to the person who's asking the question's point, a lot of it kind of ends up being externalized, right? So if you're, say, Tesla, the people who actually mine out the lithium and cobalt probably don't have as good of an ESG rating as you do, and not all companies necessarily look into where the supply chains are coming from. Kind of like as we stated earlier on, companies are not required to report all of these things, so they're not required to say where their supplies come from, and it's part of the problem as to why tech companies rate so well and have had such a huge run up, because they kind of externalize a lot of their, let's say, bad behavior.
Yeah, Chip said it really well, and the question itself hits it right on the head. Is how do you compare that? Like, how do you match that, and how do you trace that back, and how do you report that? It's all things that haven't been fully formalized or made clear. It's rating agency dependent at this time, which is unfortunate, because then you have to try and compare multiple rating agencies.
No, that's fair. And there were some follow-up questions, but I think you guys answered it. They were asking pretty much which scopes of the 1, 2, and 3 of ESG are they being benchmarked to. But it sounds like that's still it varies from agency to agency. Okay, another question here that we got coming in is assuming ESG reporting is standardized, where do you think this leaves Canadian oil and gas ESG ratings? What does this mean for Canadian oil and gas attracting capital?
That's a really good question too. So we actually one of the infographics we have in there does touch on this a little bit, and again, probably my memory going to fail me here a little bit, but Canada as a whole has a pretty high ESG rating across the board, and is well set up to be a leader in this space. Having said that, it does again kind of have to rely on the fact that these things become a little bit more standardized and then a little bit more industry agnostic, because yes, there are situations where it's not the easiest here, but yes, for Canada and the oil and gas industry itself, we do have a bit of a lead in that space.
Yeah, and further, like you know, Canada has for example, great safety ratings for a lot of their projects. Our governance is quite transparent and open, right? Like when you compare us to, say, like national oil companies kind of across the way. And typically how we treat the environment, like after a project is completed, is quite highly rated. The main problem for Canada is, you know, the emissions that are generated from pursuing these projects. And like obviously that's something that many companies are working on and like progressing quite positively, but a lot of the information seems to show that perhaps if there was an actual standard ESG rating that was applied globally, that it would actually potentially drive investment into places like Canada that are well managed, that are transparent, that treat their employees fairly, and that work on reducing their emissions going forward.
Okay, great. Just a couple more questions left here. We're slowly coming to 1 p.m. at the end here, but this question again asks kind of more about the actual ESG rating calculation. It says, is the environment aspect of the rating more heavily weighted than social and governance? Do industries have a broader ESG that influences the rating of a company in the industry? And is it possible for a company in historically bad ESG, oil and gas and services, for example, to have a good ESG?
Yeah, that's a good question too. In terms of the weight of it, the way that MIT broke it down, it ended up being that the weight was one of the least impactful factors in terms of divergence of the rating agencies. What was more impactful was essentially some almost like the rating bias to a certain extent of how they rate the factors. Now, specifically talking to whether they whether they put more weight to environment versus social and governance. Chip, I think, again, my memory's probably failing me a little bit, but that is not my understanding of how they generally do it, but it's, again, different from firm to firm. Am I in line with that?
Yeah, I think generally the environmental aspects kind of for a lot of these ratings agencies are just like easier to put a number on.
Yeah.
So things like emissions, waste, water use, pollution, etc., are physically measurable phenomena for the most part. When you get into discussing things like human rights and the rights of workers, board transparency, board diversity, putting a number on that is kind of more difficult. So the issue ends up being that, like, while environmental ratings don't say outweigh drastically the other two, that there is like just far less agreement about what are good standards for the social and governance aspects. So a lot of the times when you look into like ESG ratings, ESG investing, the majority of the focus ends up being the environmental stuff because it's measurable. It's something that you can like legitimately put a number to that people would agree upon.
I think then the follow-up to it a little bit as well is, to Chip's point, if something like a safety rating is extremely high, something like an oil and gas services company with a really high service rating, really high health and safety rating, would balance out their, ESG rating as a whole based on that to a certain extent. So that would be the hope of making this a little bit more standardized, is that the net positive ESG rating is more balanced out and is more in line with making things better as a whole versus one more heavily weighted than the other.
Great. No, that makes sense. Okay, we have our last question here. We'll end off with this, and it kind of focuses back on how this impacts us, and you talked a little bit about that. And the question is, how should the mindset of the people working in technical roles, so engineers, geophysicists, geologists, reflect or change as a result of this change in the mindset of investors and organizations?
It's a good question. So we tried to address that a little bit in that last slide or two there in summary of breaking it into how you invest your own personal money and considering the source of these ratings. First of all, considering the direction that you want to go and considering the values that you hold. Similar to the career path, we wanted to go the same route. Basically, understand the data that's behind this before making the decision, and for lack of a better term, just jumping on a bandwagon or trend that seems to be popular, and really understanding what's behind it, and making sure that you're in alignment with your career and your goals, with the actions, comments, statements, etc., of whichever company you're working for. In terms of mindset, the hope would be here is if we can get to a place where we're comparing things that are similar across industries, across countries, across markets. The idea would be that if we're already kind of doing well in that space, let's continue to have our mindset go towards how can we continue to improve ESG as a whole for a net positive impact on the environment, on the social, and on the governance aspects. So I would say that essentially bottom line is make sure you question the source and the intention behind all the actions that are being made, as well as essentially what your actions will be, and make sure that it lines up with what you're hoping to gain and what your values mean.
Yeah, and just to add to that, I think for people working in technical roles, a lot of the writing is on the walls, right? Like, financial institutions are saying that they will provide less credit to companies that don't abide by these standards. Governments are going to push harder to implement like nationwide projects about either carbon pricing or reducing emissions, etc. So I think from like a technical role point, it's about keeping your eyes open to what decisions you can make within the companies you work to like address this coming tide, right? Like, you know, what projects can be done that will hopefully lower emissions, what projects should be undertaken that kind of account for this future that is coming, and how to like situate yourself in those positions to act.
Yeah, I think I'll just add on the last point too, which I'm not sure if I did mention it previously, but 20 carbon zero by or emission zero essentially by 2050 is now the goal for many countries. So that is a push that's coming. And there's a lot of unique kind of strategies, decisions, and changes happening as a result of that. And while we know that not always are goals set, not all goals set are met essentially. And some of these things, like you have a goal of like this will be up and running and good to go in 10 years, the landscape changes, right? So essentially the thought process being, if that's the end goal, what can you do on an incremental daily basis that matches with your values and also can kind of lend to those goals in the future?
Great. Well, there are a few more questions, but unfortunately we've run out of time here. So you do have Griffin and Cyprian's contact information. Sorry, I think it's Energy Minutes contact information there on the slide that you can reach out to. But Griffin, Cyprian, thank you so much for your talk today. Truly insightful look into the data for ESG, underlying ESG, and the impacts it has. So this concludes our webinar for today. And thank you everyone for joining us. Have a great rest of your day.
Thanks for having us.
Appreciate it.